Hello, this is Simon Thompson, Vice President and Wealth Advisor at Texas Legacy Wealth Management. Welcome to our monthly market update for March 2016. We're going to walk through the major market events of the month. Stocks continued their rebound in March with a 6.6% gain for the S&P 500, bringing the index into positive territory for the year, rising a little shy of 1%. The March rally capped off a historic quarter. Q1 was the first quarter since 1933 where we have seen the market down 10 or more percent for a quarter, only to finish the quarter in positive territory. Since 2002, 10 separate months have gained at least 6%. The following month was higher 8 of those times, with an average gain of 3%. During the month, we watched the S&P 500 move higher along with the price of oil as the U.S. rig count continued to decline and investors continue to hope for oil production freezes from OPEC. Also playing a key role in the market rally was rhetoric from central banks around the world, as the Fed and European Central Bank both held important monetary policy meetings during the month. The Fed's March meeting helped boost the market as the updated dot plot showing future interest rate projections brought the Fed's rate hike expectations for the year down to 2 versus the 4 they predicted in December. This change brought the Fed's projections much closer to market expectations for hikes through the end of 2016. The Fed cited global weakness and market volatility as reasons for caution. Despite discussing these areas of concern, the Fed will likely continue to be data dependent and closely watch economic data, particularly employment and inflation releases. Employment numbers continue to be strong and improving, but with the implied inflation rate around 1.6% in March, the Fed likely sees room to tolerate inflation before raising rates. Across the Atlantic, the European Central Bank continued on the path of easing monetary policy in an effort to support the European economy. The March meeting and press conference saw the ECB announce an increased bond buying program and move interest rates further into negative territory. By pushing rates further negative, the ECB hopes to encourage lending by European banks in an effort to expand economic activity. There has been much debate about the effectiveness of negative interest rates, and some feel that negative rates could end up hurting economic growth. Thus far in 2016, we've seen the dollar weaken almost 4% since the beginning of the year, driven largely by a dovish Fed and expectations that interest rates will remain relatively low throughout the rest of the year. A benefit of a lower dollar might be seen in first quarter corporate earnings, as we currently see a 3% dollar headwind for first quarter earnings versus the double-digit headwinds experienced throughout 2015. If the dollar remains at these levels or weakens further, we could see the dollar headwind for earnings abate over the rest of the year. Removing this headwind could significantly improve corporate earnings, especially for the multinational and commodity-focused companies looking toward the back half of 2016. We continue to be cautiously optimistic looking to the rest of 2016, as we don't see a recession on the horizon, but feel that there are some factors that should be monitored: supply and demand of oil, central bank positioning, geopolitical events, and currency fluctuations. With the improvements we've seen in fundamental economic data since the beginning of the year, we continue to feel that positive returns for stocks by the end of the year are possible, but expect to see further volatility as the year plays out. For more information about Texas Legacy Wealth Management, you can contact us via phone, email, or feel free to visit our website. We'd also like to remind you to follow us on Twitter and like us on Facebook.